Well, hello. This morning I am with Russell Marsan. He is the Senior Vice President of Investment Property Exchange Services, and he is joining me on the couch for a cup of tea. So, Russell, what is a 1031 exchange?
Well, first of all, thank you very much for having me here, Beth, for a little spot of tea.
Absolutely, can't do anything without it.
I watched a couple episodes of Monty Python just so I could, work on the accent before coming here on
Oh,
the meeting
thanks,
today. Yes,
yeah.
You're very welcome. So a 1031 exchange, it's actually kind of a little-known section code in the Internal Revenue Code, but it's actually the greatest wealth-building tool in the entire Internal Revenue Code.
Now that I'm interested in, wealth
Yeah,
building.
wealth
because
building.
when you say what you said before didn't sound interesting,
Exactly.
but wealth building, I'm all ears.
Yes. So it is the greatest wealth building tool in the entire Internal Revenue Code because it allows real estate investors to reposition their assets throughout the course of their entire life without having to pay taxes, right? Because as an investor in anything, but in this case it's real estate, as I grow in life, my objectives change. Right? Early on, I don't have much money, so I'm trying to build wealth, right? Appreciation. So I'll buy single-family homes, right? Later on in life, I own a bunch of real estate. Now I want to maximize cash flow because maybe I'm going into retirement or I'm tired of management headaches, so I want to go into something more passive. So those are all different types of objectives. And the 1031 allows you to reposition throughout the course of your entire life to better meet whatever your current financial objectives are. And every time you reposition, you don't have to pay any tax. So you're moving all of that money forward, especially California taxpayers. I mean, this is the heaviest tax state in the country. On average, you can pay around 35% in taxes, between the state and feds. It can be in excess of 40%, but on average, about 35%. So every time you're repositioning, you're keeping that 35% working for you, earning cash flow, appreciating, and so on and so forth. And that's why it's the greatest wealth building tool in the Revenue Code.
So when you are doing buying and selling the properties, do they have to be exactly the same kind of properties?
Yeah, well, there's this term, like kind, in the
I've
1031
heard that.
world. Yeah. And it's actually the most misleading term in our industry.
Okay.
Because I'm a visual person, right? And if you tell me something has to be like kind, then I think, oh, well, it has to look the same. So if I'm
Condo
selling...
for condo.
Yeah, condo for condo, land for land,
Yeah.
right? Commercial for commercial. It's not the case. Something is like kind not because what it looks like, it's like kind by how it's treated. Any type of property that is treated as business or investment is like kind with any other type of business or investment property. So therefore, you can sell raw land. If you own raw land you're not farming or ranching, it doesn't provide any income. Right, so no cash flow. It doesn't provide. You can't depreciate it.
Nope.
Right, so it's a negative cash flow vehicle. You just pay your property taxes and hope it goes up in value. You can sell that and free up that stagnant equity, right? And you can buy income property because it is like kind. So you can buy a rental, for example. And now that you own a rental, now you have cash flow coming in on the value of that asset. Now you have depreciation to shelter the income. And now in a lot of cases you have a faster appreciating asset.
And do you have to own the property or the land or whatever it is, the like kind, for any specific amount of time?
There is no stated time period. Like if you buy a property, there's no stated time period by the IRS that says this is how long you must hold it before you can turn around and sell it and do a 1031 exchange. The IRS doesn't care about time, they care about intent. And your intent must be to hold for business or investment purposes.
Right.
So for example, flipped properties, which are really called inventory properties in the IRS's eyes. Inventory properties don't qualify for 1031 deferral. So you want to make sure that if you've owned a property for a short time period that it doesn't look like it was just a flip, right? So if you've had a little bit of rental history into it, and then you've owned it for at least like a year or so, most tax advisors seem to agree 1 year is pretty safe. So if you want to buy a property and sell it soon, try to own it for at least a year and get a little rental history into it if you can.
So what about different states? We're here in California. Is it possible to sell something in California and buy in Wyoming. I don't know why you'd want to buy in Wyoming personally, but hey-ho.
Well, yeah, you can. 1031 is federal. And I'm not sure if your viewers out there have heard, but there's this thing in California called an exodus.
Oh yes,
yes,
there
yes.
is. Actually, they're not moving fast enough
Yes.
from here
So-
because we need more properties to sell.
Yeah.
But
And I see, I've seen it. I've been doing this for 27 years, right? And for about the last 7-8 years, I've seen a substantial amount of people exiting the state. But what happens is a lot of people just exit the state personally. For whatever reason, they don't like the state anymore, and they want to sell here, and like you said, they want to buy in Wyoming, right? Well, they're just moving their primary residence. They're selling primary residence here, which is a tax-free sale probably, and then they buy in Wyoming. They're leaving their investment properties here. You don't have to. I mean, why? If you're going to move to Wyoming, why would you want to manage from 1,000 miles away?
it's very difficult
Very
managing
difficult.
properties in different states. I know from personal experience.
And California is not a landlord-friendly state,
It's
right?
not.
So you could sell here in California, and you can do a 1031 exchange into Wyoming. And in fact, you can sell one property here and probably buy, I don't know, half of Wyoming.
I've got another question. What if you buy a duplex and you live in one half and you rent the other half out?
Oh, great question. That's called a mixed-use exchange, right? So because it's one property, but it has multiple uses, part
Yes.
business and part personal. So part of the property qualifies as your primary residence if you've lived in it for at least 2 years, which, by the way, that section code is called Section 121. And that's where if you're single, you get $250,000 to exclude of capital gain, $500,000 if you're married. So if you live in a duplex, both square footages are the same, both sides are the same square footage, let's say, and you live in half and rent out half, and you've lived in it for 2 years. When you sell it, let's say you sell it for $800,000, half the sales price,
So 400,000.
$400,000 would come to me completely tax-free at closing, right? Because that was my house. The other half, $400,000, would need to flow into a 1031 exchange. So I would need to buy some other type of investment property that's going to provide me with income for $400,000.
To avoid paying tax on that.
Yeah, so you eliminate some
400,000.
tax.
Of course.
And you defer the rest. But the net is you pay no tax.
Well, that's what we all want, isn't it?
Yeah, but it's not just a duplex. I mean, that's the easiest example. There's more complicated and lesser known examples. Since the pandemic, a lot of people have been doing in-home offices, right?
Yes.
And claiming that on their taxes.
Oh.
Okay, that's a business use. That's a mixed use. And so somebody might be thinking they're selling their primary residence and they're within their $500,000 capital gain exclusion, so they assume that there's going to be no tax when they sell it, but there is if they've been claiming an in-home office because they've been depreciating that property, right? And when you depreciate it, depreciation recapture is also taxed. But that is not sheltered by Section 121 when you sell as your home. So if you sell as your home, you're going to be taxed on the depreciation, even if you're within your $500,000.
Okay.
Unless you do an exchange on that portion of the
Portion
sale.
of it, which in most people is quite a small portion.
It could be, yeah. It could be substantial. I mean, if the CPA tells them you're only going to pay $2,000 in taxes and recapture, just don't do an exchange, just pay your tax.
Yeah.
But if the CPA says, no, you're going to pay $60,000 in taxes, okay, at least now you have the option, right, to not pay that tax and do an exchange.
So what happens if I get to a stage in my life where I'm fed up with rentals? Maybe I'm retired and I want to just sell off everything.
Very common. So what happens is, especially, let's say that I'm in my 20s or 30s and somebody tells me, you should buy real estate, it's a good investment. Super common, right? So I buy my first investment property. It's a fixer-upper house. After a couple of years, I have some sweat equity in the property. It's appreciated a little bit, which is nice. Maybe I have a little positive cash flow coming off it. And I'm like, hey, this is really cool. My wife and I decide, let's do it again. We do something else for a living, right? This is a side hustle
Yes,
for us,
yeah,
right?
absolutely.
So we buy another one, and eventually another one, and another one. And now we're of retirement age. And now we own 5, 10, 15, 20 single-family rental properties. This is a very common scenario, right? So now in my early 20s, it was fine owning and managing single-family rental
Yeah, no,
properties.
absolutely.
Yeah. Now, now I'm 60 in a couple months, right? Now I'm getting tired of that, right? So, and now I just want to, before I wanted appreciation. Now my primary financial objective is I have a lot of equity. Now my primary objective is cash flow, right? So, and if I own single-family rental properties and my objective is cash flow, I shouldn't own them. I should buy other types of real estate that are designed for cash flow, and that'd be in the commercial sector, right? And you can even go passive, like in triple net leases and things where you own real estate and you have zero duties and responsibilities or expenses, right? But the thing is that people that only own single family rental properties, that's the only asset class they're familiar with. So they don't know their options in commercial. They're not comfortable with commercial, even though commercial is what they should be going into, right? Rather than more cash flow, let them go passive. And that's where kind of something like the DST, the Delaware Statutory Trust.
Yes, explain that to me.
Yeah, the DST is a form of replacement property in a 1031 exchange. The IRS formally approved the DST structure back in 2004 with a revenue procedure. So it's been around a long time. There's a lot of history in the 1031 world. But what it is you're buying a fractional ownership interest in an institutional grade asset. And what that means is a very expensive asset. It's 80, 90, $100 million property, right? And you're just a passive owner in the property, right? So all you do is just receive monthly income that shows up in your bank account.
That sounds rather nice,
yes.
actually.
You'll never get a call from tenants at midnight. You'll never be asked to repair something or pay to repair something. It's 100% passive. So those types of investments are out there, and they are like kind in 1031, but a lot of people don't know what their options are. So they'll just sell their real estate when they're of retirement age. They'll pay their tax, and then they'll invest the proceeds into like muni bond funds or something like that, right? To go passive.
Right.
Well, why would you give up 35 or 40% of your income for the rest of your life in taxes? To meet that objective, you can just exchange into real estate that suits whatever those needs are.
Okay, and what happens when you die? I mean, that has to be the obvious next question.
Well, we all want to know that.
Okay, what happens
there's this light?
to your monthly income that's coming in when you die?
I was like, wow, you're about to answer a really big question in my mind.
No, I'm not psychic. I wish I was psychic, but I'm not.
So from a standpoint, what happens to the taxes when you die? A lot of people sell their real estate and don't do an exchange because they're under that misconception that taxes are inevitable.
Yes.
Right?
Yes.
Yeah.
They feel like they are.
Well, we've been told all our lives that two things are inevitable, right?
Death and taxes.
Death and taxes. Exactly. You knew that right off the top of your head.
Absolutely.
And we didn't rehearse that or anything. But that's a lie, right? We've been lied to all our lives. There's only one of those is inevitable. Of course, we know that's death. Taxes are not inevitable. Current estate tax law is incredibly favorable. Less than 0.1% of all estates in this country pay any estate tax. It's not a revenue source to the Treasury because there's a floor currently. It's approximately $11.5 million. So if you're single and your estate's below $11.5 million, there's no estate tax. If you're married, it's double that, over $23 million. And your heirs get a step up in basis. This is the super cool part. So, if I bought the property 50 years ago, right, for $100,000. I pass away yesterday, which makes this conversation awkward.
Really?
It really does. So I passed away yesterday, and it's worth $2 million, right, when I pass away. Well, my kids, as soon as they go on title to it, their basis is stepped up from my old $100,000 to the $2 million, the fair market value as of the date of my passing. They can call you, Beth, right after I pass away and say, hey, we want you to list and sell Pop's old property. We don't like it anymore. And they don't need to do an exchange, right? They have no tax consequence.
Wow.
Because their basis is $2 million and they're selling for $2 million, right? There's no profit there. There's no gain.
That's really good to know.
Yeah, they don't have to buy other real estate. They can do whatever they want.
You're
with those
really
funds.
quite interesting.
Well, thank you.
So, one sort of on the last thing really is I understand because of the flood situation certainly in California right now, things have changed as far as the 1031 rules and regulations.
Yeah, specifically the time periods, right? Because the most restrictive part of a 1031 exchange is that 45-day identification rule, right? That's very restrictive.
Yes.
And a lot of people kind of wait until the last minute to start looking for properties. And when you have only 45 days to look for a property, that can be panicky.
And right now it's particularly difficult because we have so few properties for sale.
Low inventory markets are challenging in a 1031 exchange for sure. That's why I always encourage people to begin, writing offers on a replacement property prior to closing on the relinquished property, because that way their clock hasn't started. Yeah. Right. But still, the 45 days is still very restrictive. Well, currently, I'm going to say about 97% of California qualifies for an extension that is considerably longer than 45 days because of those floods that happened earlier this year in California, because that created a federally declared disaster. And whenever there's a federally declared disaster, there are extensions issued to 1031 exchangers. And so the ones that were issued earlier this year, initially, back in early January, the extension date was to May 16th, right? So if one of your deadlines fell between, let's say, January 8th and May 16th, then that date would have been pushed to May 16th. So if you had, let's say you closed on a property in February earlier this year, then March 15th would have been your normal 45th day deadline, right? Well, that pushed it to May. That was 2 extra months they gave you, right, to identify, which is over doubling the exchange, the identification period. But what they did a couple months ago, the IRS, and they've never done before, ever, is they issued a second extension on that disaster.
Oh, right.
Yeah, it pushed it all the way to October 16th. So currently, like if somebody enters into an exchange now, let's say they close July 1st, right, with their relinquished property, that would start their clock. So normally August 1st would be their 45th day identification deadline. Well, now it's September, October, right? So they have an extra 2 months on top of the 45 days to identify. So you can sell now and go ahead and just wait. You get an extra, you'll have 3.5 months for something to come on the market, right? Instead of just 45 days.
And when you say identify, explain what you mean by that for people.
Yeah, well, so whatever the deadline is on their identification, whether it's the 45th day or October 16th, prior to that deadline passing, you can change your mind on identification. You can name any property you want. But as soon as that deadline passes on midnight, you're locked, you're set in stone on only buying something you've identified. Now, there's what I call kind of the informal identification and the formal. So between now and their deadline, let's say it's 45 days, between now and their 45th day, the only thing they have to focus on, if they're going to buy one property, just find that one property, right? Write an offer. If you lose out, write another offer. If you lose out, write another offer. I don't need to know anything about that.
Right.
Once they get into contract, I need to know about that, right? So, and then we can get that side of the exchange set up. If their exchange is going to go past the identification deadline, the 45th day or October 16th, that's when they need to fill out the identification form. We don't want that form until right at the deadline.
Okay.
So I don't want you to name backup properties.
Yeah.
Early on, it's a waste, right?
Yes, waste of everyone's time.
And that's when we talk and say, okay, well, how's it going? You know, are you really looking good on the property you're in contract on? Is that going to close? You're sure? Okay, well, don't identify anything. If it's a little shaky, okay, maybe you want to identify some backup properties. And that's when you would just name on this form, okay, here's the one we're in contract on, and here's 2 other properties that are for sale that we wouldn't mind trying to buy if this one falls out.
So at that stage, we're telling you about it, but what exactly do your company do?
What do we do?
Yes, yes. You're a world of information, a wealth of information. But
my wife asks me that question every day. What do you do?
Yes, well, I'm not going to go there. Can I take the 5th? I know I'm not American, but I'm going to take the 5th on that one.
Yeah, we're what's called a qualified intermediary. It just so happens we're the largest qualified intermediary in the entire nation, and I've been doing exchanges for 27 years. But you have to use a qualified intermediary to do a 1031 exchange. Somebody has to act in that capacity. And what we do is we assign into, once they're under contract with a buyer on the property they're relinquishing, this property they're selling, then we have to assign into that escrow before it closes. Or we have to be in place before it closes. We assign in as the seller on behalf of the exchanger, which gives the closing company instructions to wire funds to us upon closing. We then create a segregated commercial bank account that we name the client on, so they know we're not playing with their money, and those funds just sit there static in that account waiting for them to buy something.
Right.
And then we assign into that, and we transfer the funds into the buy side. So we do all of the wiring and all the accounts and all the transferring and all the documentation that's required by the IRS. One thing you have to be careful with in our industry, it's a little known fact, unfortunately, our industry is 100% unregulated by the federal government.
Unregulated?
Unregulated, yeah.
Wow.
There's an assumption that we're regulated because we're in the industry field.
Yeah, no, absolutely.
Yeah, you as a realtor...
Especially in California, I would have thought everything is regulated.
Yeah, you as a realtor are heavily regulated.
Absolutely we are.
Title companies, lenders, they're all heavily regulated. We are not, which is unfortunate because that means anybody can do what we do. No licensing or bonding, insurance. We can legally commingle funds if we want to. We can invest them while we're holding them to try to make money on the funds while we're holding them. We can do all of those things legally, and that's unfortunate because a lot of people have lost money over the years through qualified intermediaries for various reasons: theft, embezzlement, bankruptcy, not safeguarding funds, things like that. We are the largest in the nation. We're also a Fortune 500 company. So we put voluntarily into place the highest level of safety and security and transparency in the entire industry, not just to protect our clients, but also to protect our stockholders and our position as a Fortune 500 company. So we have the very highest level of safety, security, and against funds and transparency. And the clients, while we're holding their funds, they're actually going to earn the interest on the funds, not us.
Well, Russell, you've given me a lot of information to think about. You obviously are the person to come to if we're going to have a 1031 exchange, and I have plenty of my clients do 1031 exchanges. And I would like to thank you for all this information. It's very interesting.
It was my pleasure. It was wonderful having a little spot of tea with you.
Absolutely. We should have had